Good evening, sir.
Yeah, good evening. Can you hear me?
Yes, I can hear you.
Mm,
Okay.
Please mute your videos and mute your mic. I really do not want to disrupt the class today. I don't want to force everybody to mute their mic. So please help me to help so that we can contribute effectively towards this class. Ensure that you don't have to talk, right? Ensure that you don't have to talk, right? Is that clear? Mute your mics and mute your videos so that it's be fine for everybody. All right. Think we're good? Right. Okay. Yeah, good evening, everybody. Can you all hear me?
Yes, we can.
Yes, sir.
All right. All right. All right. All right. All right. All right. You can hear me? Please mute your mics so that everybody can be fine together. I'm begging that you should please mute your mic. Please help me. Please help me. Mute your mics and stop the video. Stop the video. I mean, mute your mic and mute the video so that everybody will be fine, right? We don't have to disrupt the class, and we have little time. We have little time. All right, so let's get into this. The whole gist. Let's get into the whole gist, right? So today we are discussing cost of capital. That's what we want to discuss today. Let's see how that moves us. Let's see how we're able to do. Uh, Please mute your mics. Please. I don't. I wouldn't want to mute everybody because if I mute you now, I won't be able to unmute you until after the class. And you may have one or two questions you may want to ask me. So muting you is not the best. Notwithstanding, I understand the fact that many people don't like to follow simple instructions of muting their mics. But anyway, let's see how it goes. Actually, left to me, I wish that I'm not forced to I'm not forced to log anybody out or forced to mute everybody's mic. Right. So getting to it now, what we want to discuss, please confirm that you can still hear me if you are hearing me.
Yes, we can hear you.
Okay, that's fine. So okay, so today we are looking at cost of capital. So what is cost of capital? Cost of capital is actually very crucial to determining. Can you see my screen?
No.
Okay. Every minute from now, you should be able to see it. Is it coming up? Can you hear me?
Yes.
Can you see my screen?
Yes.
Yes, sir.
Yes.
All
Yes,
right.
we
So
can see your screen.
I was saying that cost of capital is very important to determining whether or not a firm should undertake a given project. So cost of capital is crucial in determining if a project should be undertaken or not, right? I'm sure your PM or your management account, you must have heard of discounting factor, right? Which is really a percentage raised by the number of years that you have in a given question. So what we want to determine largely here is how do they determine the discounting factor, which is the cost of capital, right? So the cost of capital is useful in determining the discounted cash flow analysis in order to determine whether an investment should be undertaken or not, right? And don't forget that the ultimate goal in the calculation of cost of capital is to obtain the firm's marginal cost of capital to use in valuation analysis or capital budgeting. Don't worry, you understand everything as time goes on. But just take it from me that we need cost of capital in determining what is the the best investment decision to take into consideration, or in determining uh, the value of the value of the business, right? So the marginal cost of capital is the weighted average of the opportunity cost of its financing option. I take that again. I said the marginal cost of capital is the weighted average of the opportunity cost of its financing option. So the weighted average cost of capital is expected to take into consideration uh, the cost of equity and the cost of debt of a given business, right? Don't forget that I don't know if you've done sources of finance, but you know there are sources of finance can be, or there are three basic ways in which a company can source for its finance. That's three broad category. Is that you get money from yourself or from the owners of the business, that is equity, or you get money from third parties, that is debt, right? Or you get preference shares, right, which could either be in form of debt or in form of equity, depending on the nature. whether it is redeemable or irredeemable preference shares, right? But don't forget that irredeemable preference shares may take on the nature of debts or may take on the nature of equity, right? So, and the other thing you need to take note of is that in determining who to pay, right? In determining who to pay, you consider preference dividend before the equity owners or before the ordinary shareholders of the business. The first is you pay your debt by way of interest, right? You service your debt by way of interest, or you pay the returns on debt by way of interest. Then you pay dividend, preference dividend, right? Before considering ordinary dividend. Is that clear? Please confirm that you can hear me, please.
I can hear you.
We can hear you.
Okay, that makes sense.
I hear
So
you, sir.
that is one thing you may want to. So I think we're good to move from here, right? So to determine the weighted average cost of a firm, so weighted average simply means that you have to consider each source of fund, right? Determine their cost. By their cost, we mean their returns. What is the average return that equity expects in a given period? What is the average returns that debt expects in a given period? And what is the average amount you expect to pay to preference dividend in a given period? Then the market value weights for each of capital will be determined and applied to each debt component as a weighting factor, right? Then it is important for us to determine the weighted average cost, or it is important for us to know that the weighted average cost of capital is determined on an after-tax basis. Don't worry, we will explain what that means in the next couple of minutes, right? So now, given that we have three major sources of fund, right? We said we have equity, we have preference dividend or preference shares, beg your pardon, and then we have debt, right? So let's look at cost of equity. And the cost of equity is the minimum rate of return the firm should earn on the net equity funds raised by it in order to leave the market price of the equity stock unaffected. Given that there is an assumption on equity that the current market price of equity is the assumed dividend that you will get from from investing in that shares. That's the assumption, right? That the market price of share is the assumption of or is the present value of dividend that you get from the investment, right? So to determine the cost of equity capital, it is then important for us to note that the rate of return required by each stockholders. When the cost of new equity is to be calculated, the rate is adjusted to take into account the flotation cost incurred by the firm to issue additional stock, and the flotation cost can actually be referred to as transaction cost. Hello, can you hear me? Hello, can you hear me?
I cannot hear you.
So how did you
I
respond?
can hear you now.
How did you know that was okay?
We lost you at the
Because your
point.
line was breaking. It was going off and on.
Oh, sorry about that.
We can't hear you.
All right. What was the last thing you heard?
We're talking about the determining the weighted average. No, the cost of equity. You said to determine the cost of equity.
Okay, so to determine the cost of equity, right? We said that.
And sir, we can't see the screen again.
Can you hear me now?
I can hear you, but your
Yes.
screen is not showing again.
Sorry, I was having issues with my throat, so I had to take water. That was why I muted myself. Can you hear me now?
Yes,
Yes,
sir.
sir.
Can you see my screen?
Yes, sir.
No.
Yes, sir.
Okay, so if it is no from your end, I would advise that you actually maybe you should check from your end if the issue is from the network, right? Do we have anybody watching us from YouTube? So just a minute. I just like to carry everybody along so that we'll all be fine together. I want to ascertain that we have people. All right. So we said there are several methods that is used in determining the rate of return of equity. We have the dividend forecast approach. We have the realized rate of return approach, the capital asset pricing model, the arbitrage pricing model. I will still discuss, or we will still teach you capital asset pricing model in detail. Then we have the bond yield plus risk premium approach, the earnings price ratio approach, right? But out of all of this, right, the most commonly used is the dividend forecast approach, the capital asset pricing model, and the PE ratio, right? Now, let's get into the capital asset pricing model. The capital asset pricing model is actually premised on the fact that the cost of equity uh, should be equal to the return on risk-free securities plus the company's systematic risk. We call that beta. They multiplied by the risk premium, right? Are you with me?
Yes, sir.
Why the risk premium is the difference between the market risk minus the the risk-free security rate. So let me explain what risk-free security rate is, right? Currently in Nigeria, treasury bill should be around 21% or thereabout. So that is that is actually what we call the risk-free, the investment that investors will take, and there will be no risk at all. Are you with me? Is it clear?
Yes, it's clear.
It's quite certain that if you invest in uh, treasury bills, you are going to get your money. So that is risk-free, right? So that is the returns that your treasury bills will give you most times is the risk-free securities, or is the rate of return on risk-free securities, because that is considered to be the risk-free securities, right? Why systematic risk, you may want to ask? Systematic risk are you with me?
Yes, sir.
So we have two types of risk, right? We have two types of risk. We have the systematic risk and unsystematic risk. So systematic risk, as the name implies, is a kind of risk that is associated with the system, that is with the company. Are you with me?
Yes.
That is, the company can actually control. Sorry, beg your pardon. Systematic risk is a risk that affects the entire country, not the company. Unsystematic risk is a risk that affects the company specifically, right? So it is safe to say that the systematic risk, which is the better now, is the risk that will affect entire country, for instance. So, for instance, you have your interest rates risk, you have your inflation, you have political instability, and the likes, right? Or you are so at long run, we are saying that systematic risk is a risk that the company does not have control about, right? It is affecting the entire system, it's affecting the entire country. That's what systematic risk is. Although in a subsequent class, we'll still look at what systematic risk is in total or the broad overview. But take it from this class that systematic risk is that risk that affects the entire country or the entire geographical environment where the company operates or where a business operates, right? So invariably, we are saying that the company does not have any influence on that risk. For instance, if you are operating in Nigeria now, irrespective of how you're likely going to manage your cost, you're likely going to be having a high cost of operation. That is systematic risk, right? Because most of the increase in cost is actually going to be influenced by inflation. Is that correct? Hello, talk to me now.
Yes, you are correct.
Yes.
Yes, sir.
Yeah, correct.
Yeah,
So that
Yeah,
is
correct.
systematic risk. Opposite of that is unsystematic risk. Unsystematic risk is also referred to as idiosyncratic risk or residual risk, specific risk, or diversifiable risk. We are saying the same thing. And that is that risk that the company can manage. It affects a specified company, right? There are internal factors. Example is your let's say your product performance or your inability to earn very well or your business failure or having just one source of income, concentration risk, and the likes like that. So those are referred to as unsystematic risk, right? So systematic risk is measured by beta. So what is now the risk premium, right? The risk premium is the difference between the market price, right, and the risk free. That is, okay, let me give you an instance. If we expect that the return threshold is about 5%, so the 5% becomes the risk premium. 5% becomes the risk premium. That is the, what do I call it now? The additional benefit you get from investing in a particular kind of asset, right? Investing in a particular kind of equity, right? So let's look at the formula now. Cost of equity is equal to risk-free rate of return plus the market risk premium, and the market risk premium is measured by expected returns from market minus the risk-free returns, they're multiplied by the equity beta. That is the systematic risk of equity. Is it clear now?
Yes.
Do you get it to this extent?
Yes.
Sure.
Yes.
So the market risk premium is the difference between expected rate of return, I've explained this, expected rate of return on the market portfolio and the risk-free rate. So that's the additional benefit you get from investing in a particular kind of equity. So what are the factors that will affect your risk premium or the percentage threshold? Why this EV? The percentage threshold of your risk premium. The first is the variance in the underlying economy. So, for instance, emerging markets like Nigeria will have higher growth and higher risk economies, while larger risk premiums, while the already developed markets will have larger risk premiums. What am I saying? I mean that those in the emerging markets will have higher growth and higher risk, right? because of level of uncertainty in the market. Why those in the developed markets, where the market can be reasonably forecasted, right, will have lower risk premium. Does it make sense to you?
Yes, sir.
Does it make sense to you?
Not yet. Not yet.
I was saying that, for instance, one of the features of the emerging market is that you cannot easily predict how the stocks will perform, right? So in that kind of environment, there's going to be higher growth. For instance, I don't know if you remember that Geregu did up to 6x last year. I don't know if you know Geregu shares in the market. Is anybody aware of that? Okay, you don't need that. But what I'm
Yes.
saying is that emerging markets, right? You cannot predict how the shares will do. For instance, last year there were a lot of drama in the market, like one thing that happened between Otedola and Elumelu, and something happened in the market share of, I can't remember the company now, but I know something happened overnight and the market share increased very significantly. That is because it is an emerging market, right? So the market is going to have higher growth, right? And higher risk, because higher risk, risk simply means the certainty in the occurrence of an event. While in the developed markets, where the market can be easily speculated, right, we have lower risk premiums, right? Number two is that there will be larger risk premium where there is potential for political instability in the market, right? So if number three is the structure of the market. If the companies listed in the market are large and diversified and stable, right, the risk premium will be lower than if the companies listed are smaller and are more riskier, right? So having said that, let's look at some illustration before we look at the past question. Is it clear to this extent?
Yes, sir.
Yes, sir.
All right, good. Eh?
Yes, but I
Please,
but I
I'm not
quickly want
seeing
to
the
ask a
board.
question, sir.
Yes, please go ahead.
Yeah. Are we taking capital asset pricing model fully now?
No, not fully now. Just taking it as a cost of equity.
Okay, okay.
Current asset pricing model is an approach used to determine the cost of equity.
Okay, yes, well understood, sir.
Yeah, so you will still do capital asset pricing model as a topic on its own. So that's when they will teach you all of the broader perspective of it. What I'm just
Hello,
doing
sir.
is
Please,
just to
I can't
introduce.
see your slides, sir.
Is it for everybody or only her?
I don't know.
I said
I
we
can
are
see it
It's
this
coming
side.
up.
So
You can see it. It's only her.
if other people can see it, then I would advise you to log out and log in again.
Ah,
Just that it is dangerous at this time. Because your logging out may mean that
your next class.
no, she will join us on YouTube. All right. Like if your screen is blurry, for those watching on YouTube, you may want to adjust your settings. You may want to adjust your settings so that you're able to see the screen. So don't forget, under capital asset pricing model, do we all get it to this extent?
Sorry, sir, my hands has been up since.
Oh, sorry about that.
Okay, yeah, good evening, sir. Good evening, colleagues.
Good evening.
To an extent, I do, but to a greater extent, I do not, honestly. It's like your speed is very, very high.
That's
So
right.
I
You're
don't know if
very
you could maybe slow down a bit too.
Okay,
Thank
no
you, sir.
problem.
very good.
All right. Sorry about that. Sorry about that.
Please,
So
can we
cost
have
of
the
equity.
can we have the formula again, please?
Okay, risk-free, M plus the risk premium. That's RM minus RF then multiplied by equity beta. That's the formula, right? Right where KE is cost of equity. Return on risk-free securities, RM minus RF is market risk premium and beta systematic risk result as beta. Make sense?
Yeah.
So let's do this simple illustration. Very simple. No thinking required. So we have KE. We are told that capital asset price, let us assume that risk-free RF is equal to what? 10%, Abby. RM is equal to 15%. And beta is equal to A 0.5, Abby.
Yes.
B 1, C 1.5, Abby. So let's solve this. So the cost of equity in this case is going to be, so we said RF, right? So RF is 10% plus, are you with me? Our RM here is 15% minus 10%. That's the RF, right? So 15 minus 10 is the risk premium, right? Then multiplied by, what is the beta here? 0.5. Is that clear?
Yes, sir.
So your K in this case would be what? 10% plus board mass is 0.5 times 5%. What do you have?
2.5.
0.5 times 5%. What do you have?
2.5.
2.5.
2.5. So K, your cost of equity here, you got to what? 12.5%. Is it clear?
Clear.
So where beta is equal to 1, your KE, I think we are starting from assuming 0 level, Abby, and I think that's best for everybody. 10% minus 10, 15% minus 10%. So 50% minus 10% is called what? To be sure you are getting it.
5%.
That's 15%, right? Please mute your mic so that we'll be fine with each other. The class is running smoothly, please. 0.5, sorry. So KE will be equal to 10% plus, what do you have? 15% minus 10% times 1.5, right? So what's 1.5 times 5? What do you have?
0.5.
What is it?
7.5.
7.5, you said? Okay.
Yes.
Then we go to
7.5.
all right. Any question at this point?
No, sir.
Any question at this point?
No question.
Okay. In the absence of question, let's quickly look at a question in the Pathfinder that we can use to illustrate this capital assets pricing model a little bit. So that
Okay.
I'll just excerpt from there. No, I'm not solving the full-fledged question. I'm only going to be doing excerpt, right? So that the idea is just to make sure that you understand the OGs, right? But like I said, SFM is what people dread so much. But for me, SFM is still one of the simplest, to be honest, because you are always free to, there's always a level of freedom in SFM, kind of. It's not rule based. Am I correct?
One can go off easily. If you miss one step, you are wrong. Like you are off.
You're talking as if you've missed one step before.
I've had people saying this almighty SFM. This SFM is even scary. The cost of capital is not looking simple compared to the stories we've been hearing. Anyway,
What
this
is
is
it?
just the big. The cost of capital is not looking so simple compared to the stories we've been hearing before now. But maybe this is just the first class. So let's see how it goes.
Brother, this is just the beginning, oh.
It's okay. The almighty SFM.
Nothing is almighty about SFM. People fail it because they dread it. That's just the reason. There's a way that what you fear so much has a way of happening to you.
True, sir.
Yes, sir.
So the idea around it is, or the best way of tackling it is, don't fear it. Just it needs you to practice. I agree. It's tedious. I agree. But at the end of the day, just don't be scared of it, because at the end of the day, you will still have to write it, whether you are scared or not. So let me quickly solve this question. Let me solve this question. Sorry. Can you see my screen?
Yes.
What I just want to illustrate here is just the capital asset pricing model, actually. All right. Let's go. Can somebody please read for me, a volunteer?
Sir,
We'll
please,
find
what
together.
question?
Question 6.
Okay, I want to read.
Let me read.
Okay.
Okay. Can I read?
Yeah, anybody,
Someone wants to
please
read.
go ahead. The first person, please go ahead.
Go ahead.
Osako, go
Director of
ahead.
JSC PLC.
Go ahead.
The directors of JSC PLC JP, an Abuja-based entertainment company, are currently considering the appropriate costs of capital to use in appraising capital investment. It is the policy of the company to assess the financial viability of all capital projects using net present value criterion. You have been provided with the following financial information of the company. most recent statements of financial position: equity finance, ordinary share capital at one naira nominal value 200 in million.
Okay,
Reserves
Ogbole.
120 for year.
Okay, Ogbole.
Okay.
All figures assumed
So
correct.
then we have non-correct. Okay, sir. Okay, assume all those ones correct. JP has an equity beta of 1.2, and the S dividend market value of the company's equity is 1 billion naira. The S interest market value of the convertible bonds is 168 million, and the S dividend market value of the preference share is 50 million naira. The convertible bond of JP have a conversion ratio of 19 ordinary shares per bond. The conversion date and redemption date are both on the same date in 5 years. In 5 years' time, the current ordinary share price of JP is expected to increase by 4% per year for the foreseeable future. The equity risk premium is 5% per year, and the risk-free rate of return is 4% per year. JP pays profit tax at an annual rate of 30% per year. You are required. Calculate the market value after tax weighted average cost of capital of JP, explaining clearly any assumptions you made.
All right, thank you. We are still going to we'll use this question as a full-fledged question, but don't forget where I started from. I started from by saying that your cost of we need to determine the weighted average cost of capital, right? And we said the weighted average cost of capital is the cost of equity and cost of debt, right? And the cost of preference dividend and the cost of preference shares. Do you remember? So I just want to use the capital asset pricing model to determine the cost of equity in this question, given that I have the data that will help me to determine that, right? So I will say using, this is November 2019, question 6. Determination. So what I'm saying in essence is that this is not the full solution to it. I'm just doing a fraction of the solution. Is that clear?
Yes.
All right. So
Yes, sir.
just using the capital as a pricing model. So now, don't forget where we started from. Your cost of equity is what? Your risk-free, your returns from risk-free securities, right? Plus your risk premium, which is your RM minus RF, right? Then multiplied by the beta of equity. Is that clear? So now let's read this question together. We were told that we have an equity beta of 1.2. So my beta is what? 1.2. Is it clear?
1.2.
Yes.
Right. So I have the market value of company's equity, right? I have the X interest market value. I don't need that for now. And I have the X dividend market value of preference shares, 50 million. I don't need that for now. We were told that the convertible bonds of JP have a conversion ratio of 19 shares per bond. I don't need that for now. Also, the conversion date and redemption date are both on the same date in 5 years. The current ordinary share price is expected to increase by 4% per year, right? For the foreseeable future. The equity risk premium, right? Now, don't make mistake. Don't forget that your RP, which is your risk premium, is your RM minus RF, right? Are we together?
Yes, sir.
Yes, sir. All together.
Yes.
And the examiner has solved the RM minus RF for you to be what? 5%. Because he told us
5%.
that it is the risk premium. And then the RF is what? 4%. That's the risk-free rate of
4%.
return is what? 4%. So therefore, KE will be equal to 4% plus 1.2, or let me just do the we have been doing before. 5% multiplied by 1.2. So what's 1.2 times 5?
That's 6.
Plus 6. So it means that your KE, which is the cost of equity, is equal to what?
10%.
10.
10%. Do you understand that to this extent?
To this extent, yes.
Good. Like
To
I said,
this
this is not the
extent,
full
yes,
solution
sir.
to the question. This is not the full solution to the question. I repeat that. You know what the examiner asks us to do is the weighted average cost of equity. Like the weighted average cost of capital, right? And we started by saying cost of capital is cost of debt and cost of equity, the weighted average of the both, right? And the cost of preference shares is what makes your cost of weighted average cost of capital. So I'm just doing a percentage of this. So it means that I will still come back to solve the question, right? All right. Let's go back to our discussion.
Sir, please
Let's
show
go
your
back to
solution.
No, I will share. You are doing of the question. I will share it.
Like,
I
show
will
the
share the
solution
solution.
yourself right now.
That's what I'm saying. Don't worry. We don't have to use more time doing that. I will share it with you after the class in your different groups. Do you understand? We have a lot more to do.
Thank you, sir.
All right. So now let's now look at the cost of equity of an unlevered company. Right? Sorry. Hold on, let me start from beginning. Let me jump. So, according to Copeland, the use of capital asset pricing model approach is often not feasible in developing economies, or the arbitrage pricing model is often not feasible in developing economies because the financial markets are often very thin and they are non-existent. So, as an alternative to these two models, to determine the cost of capital for a specific company, they suggested that first, the industry-wide real required rate of return should be estimated. Then, the debt payment should be indexed to inflation. That means inflation should be considered, right? Otherwise, the inflation premium required should be estimated and added to the real rate. So, what we are saying in essence is that the exposed price are good estimates of required rate of return if the underlying riskiness of the company has not changed. In essence, we are saying that the long-term average rate of returns are substitutes, right, for the present cost of equity. In that instance, we are saying that the cost of equity should be measured to reflect inflation, right? Should reflect inflation, right? And we are saying that, therefore, it should be measured as real rate. We are saying it should be measured as real rate. So in doing that, the following steps are suggested. The first is that data should be collected on the nominal rate of return for all the peer companies in the same industry as the company being evaluated. So the authors suggested that we should use 20 years information. But in reality, you cannot get 20 years data. So 5 years information is good, right? Then information should be collected on the market value debt to equity ratio year by year. Then the actual equity return for each year should be converted into an unlevered equivalent by using the Modigliani and Miller formula for determining the cost of equity of a levered company. Are we together, please?
Please. Yes, sir.
So in that instance, we are saying that cost of equity, this is becoming interesting, right? Will be that will be equal to the cost of equity of an unlevered company plus cost of unlevered company minus the cost of debt, then 1 minus the tax rate, then the debt to equity ratio multiplied by the debt to equity ratio, right? So we are saying that the KU is the observed levered equity return for each period. That's what we want to determine. And the KU is the equity return of equity that is unlevered. K is the cost of debt. The T is the marginal tax rate. One is constant. Then D over E is the debt to equity ratio, but this time we are considering the market value of debt. Is that clear? Is it clear to this extent?
So this one like
Yes, sir.
Eh?
CAPM. The one I gave us before was for capital asset pricing model. This one is for what?
What do you say?
I asked the formula I gave us before was for capital asset pricing model. Then this one I giving us now, talking about unlevered, is for what?
It's still the same thing as for cost of equity, but in this instance, we are looking at the cost of equity of a geared company.
Okay. Does that mean that the other one you gave us was for ungeared?
No, not for ungeared. It's all using the capital asset pricing model approach. So doesn't mean it's ungeared.
Okay, sir.
All right. So don't worry, we'll solve question now that will illustrate this. But before we solve question, right? Before we solve question on that, let's look at the dividend forecast approach. This is also one of the most commonly used approach. Dividend forecast, that one is simple actually. Let me explain this. Okay, let me highlight this. I'll come back to this one. But let me do the dividend forecast approach. And I've explained that before. I've explained that before, but I will explain that again. Dividend forecast approach. We are saying that the assumption of this approach is that the costs or the current price of dividend, the current price of equity, that's the current market price of shares, is the future amount of the present value of the future dividends that you'll be receiving from the equity shares. Do you understand? Do you understand it to this extent?
I can't.
I'm saying I want to leave this one. I'm talking about the dividend forecast approach now. We are saying that the current market price of any shares is assumed to be the present value of the future dividends that will be paid, right? In other words, we are saying that we expect that the dividend is expected to grow in perpetuity. That means we don't expect that dividend will remain constant. We expect that the dividend declared by any company will continue to grow in the near term, right? That's in the foreseeable future. In that instance, right, the cost of equity will then be dividend paid in year one, that's your current dividend, divided by the market price of shares, then plus the growth rate. And you will also see this formula when we are doing Gordon growth model in dividend policy. I deliberately skip that. We are likely going to be coming across this formula again when you are doing Gordon growth model. But let's just use this as determining the cost of equity, right? So in that instance, we said where this dividend expected at the end of year one. P is the market price per share. Are you with me?
Yes.
Are you with me?
Yes, sir.
K is cost of equity. And then G equal to what? The growth rate. So let's solve this using the same. Let's solve this question now using using the formula. The market price of that known farm. So let's solve illustration 2, right? Illustration 3. Danone Limited. Are we together?
Yeah.
Yes, sir.
Yes.
So the market price per share of Danone, one of the largest food producer, is Euro 131, right? So we have MPS is equal to 131, Abby, 131 euro. The expected dividend, that's D1, is what? 2.79, right? The growth rate is equal to what? 4.9%, right?
Yes, sir.
So you're expected to determine the cost of equity. Don't forget where we started from, right? So we are saying that KE will be equal to, what's your D1 in this case? 2.79, right? Divided by 131 plus what? 4.9%.
4.9.
Is that clear?
Mm-hmm.
So what's 2.79 divided by 131?
0.021.
0.021, right? Plus, so let's express 4.9% in decimal, right? So that's 4.9 divided by 100, right? What do you have?
0.049.
So K will now be equal to what? 0.021 plus 0.049. What do you have?
0.077.
0.07, right? So therefore,
0.071.
No one.
therefore, so if you want to express 0.07 in percentage, what do you have? KE
7%.
equals 7.
7%.
7%.
Is it clear?
It's clear, sir.
You understand this one, right? So I think the one we're having issues with is converting the cost of equity of an ungeared company to the cost of equity of a geared company, right? I mean, this is the only one you have issues with for now, right?
Yes, sir.
All right, no problem. We'll discuss. I will have to discuss Modigliani and Miller theory first before explaining that in total, so that you can understand that in details. But no problem, we'll be fine. Do you understand it to this extent?
Yes, sir.
Yes, sir.
Now, the other one we have is that, or the other approach we have is the realized rate of return approach, right? And what is realized rate of return approach saying? Realized rate of approach is saying that the rate of return that is realized by a shareholder prior to this time can be used to determine the rate of return that is required by them today and in the future, right? By them today and the future. So what is saying basically is that in determining the rate of return that you need, right? The rate of return for this current year, it is the dividend per shares for this period plus the price per share for this period divided by the price of shares at the beginning of that year minus 1, right? And DT plus PT divided by PT minus 1 is usually referred to as the wealth ratio. But this approach basically is really not useful in reality. And it has high chance of not being tested in your exam. I'm just teaching for knowledge purpose, right? I'm just teaching for the sake of knowledge. It's not going to be tested. So in this case, RT will be equal to DT plus PT divided by PT minus 1 all minus 1. So are you with me? Are you with me?
Yes, sir.
So if that is the case now, don't forget that DT plus PT divided by PT minus 1 is usually referred to as the wealth ratio, right? So the wealth ratio minus 1 can then be implied to be the cost of equity of an ungeared, cost of equity of that company, sorry. Cost of equity of that company. So now, I don't need to bother you with this. It's not realistic, basically. The other one that is realistic here is the earnings price ratio. Earnings price ratio. And that is saying that the cost of equity, right, is simple. This is the most straightforward of them. Is the earnings per shares divided by the market price per share, which is the most reasonable of all of them. Is the most reasonable. Do you understand? What we are saying is that since the cost of equity is the rate of return that you expect, right? So, and don't forget that earnings per share is assumed to be the amount. Are you with me? Are you with me?
Yes,
Sure,
I'm
we
here
are.
with you.
Is the amount that the earnings per share is the amount declared by the company that is reasonably for the shareholders. Does it make sense? You understand what I'm saying? I'm saying for this year, for instance, the company makes a profit of 1 billion naira and it has 1 million shareholders. EPS is basically 1 billion divided by 1 million, right? That is the amount of earnings that is attributable to the shareholders, right?
Please,
Are you with
please mute
me?
yourself. Oh.
Are you with me?
Please go over that again. Those are
Yes,
unmuted
we are
are
with
disturbing
you.
the class.
I was saying that the earnings per share is the amount declared as profit attributable to ordinary shareholders in a given period. Do you agree?
Yes.
Now, therefore, it means that the cost of equity is the earnings per shares, right, for the next year, divided by the market price per share. Given that on the assumption that we will continue to have that earning and the earning will continue to grow in perpetuity, then let's divide that by the market price per share, which is going to give us the reasonable price or the reasonable earnings per share a given period. Is that clear?
Clear.
Is it clear?
Yes, on this side is clear.
Okay, good.
Yes,
So
sir.
having said that now, I'll be willing to round up the class here so that in the next class, I'll be looking at the cost of debts and finally the weighted average cost of capital. So, but what you've done so far so good, is it clear apart from the Modigliani and Miller theory that I did in between that wanted to scatter
Yes.
the whole thing?
Yes,
Yeah,
sir.
very clear.
Are you sure?
Yes,
Yes,
sir.
sir. From
All
our
right.
own, too, yes, sir.
Do you have any question for me? If you have any question, please bring it up so that we can discuss them.
Sir, this material you said it should be sent to the group.
Yeah, the solution to the question should be shared in the group.
What about the main material?
Ah, oh, I'll think about it.
I
Pray
think
that
it
the Lord
was
should permit me.
about the tax.
Is what I'm asking about. I know the
Oh,
solution will be sent already.
Is the note you're asking about? Pray that the
Yeah,
Lord will give me permission to do that one. The Lord has given
amen.
permission to share the notes, the solution with you. But I've not got the permission to share the question with you.
Ha.
The issue is that it won't be ideal if we have to be practicing with answers without questions.
Okay, I will screenshot the questions and send them to you. Is that fine?
God help us. Don't touch your heart. I'll pray overnight.
Okay,
Work and pray,
no,
bro.
I can do a general favor. The note is not mine, right? And even what I'm doing now is against copyright rule. So it is not ideal for me to share another person's material to you without the consent of the author, right? So what I can do is make a note out of it, and then possibly I can, without plagiarizing, then share that with you. I think that's fair enough.
Very
that's
well.
All right. I hope you understand. We are all professionals, right? And I hope you understand what
Yeah.
I'm talking about.
Yes. I
Yeah.
think that goes fine with us.
All right. Any question for me at this point? So in the next class, we'll be treating the cost of debt. Then we'll be treating cost of debt, and after that, we'll be dealing with the weighted average cost of capital. Then I'll be solving 2 questions from the past question. So it means it implies that my next class is likely going to be longer than usual.
okay.
Do you understand? So you may want to prepare ahead of the class. My
Who
next
will
class may be
prepare?
longer than, right? So
Who
although
This
it's
will
formula
a
prepare?
that you
class, so
code of
and
earlier.
it's a marketplace, there's free entry and exit, Abby.
And to go eat Gary.
All right. Any question?
Sir, please, can you go over the EPS for the last
Can I
time?
go over it again? Is that what I had?
Ayuba is messing up this man.
What do you say?
I mean, can you go over the EPS?
Sorry, you can have access to the recording. Just watch, go over the recording again. The recording is available on YouTube.
Sir Abiodun and Ayuba, they are raising up their hand. Maybe they are waiting for you to call them.
Okay, Ayuba. Abiodun.
They've slept.
Good evening, sir.
Yeah, good evening.
I wanted to ask that what's the assumption of CAPM, like CAPM? I think the capital asset pricing model. Like, what's the assumption behind it? Like, the rationale behind it?
Okay, the rationale behind it, simply put, is that there is a risk-free security on ground. I'm talking about the practical example, the practical rationale behind it. There is a risk-free security that even if anything was to happen, I will get this amount as constant, right? The idea is that what will make somebody leave that certainty to come and invest in your firm? Do you understand? Does it make
I'm with you,
sense?
sir. I'm listening, sir.
So what would make that person leave uh, a security that is 100% assured they are going to get your money back, right? They are triple A. Triple A means they are not going to. There's not going to be default, right? Then what will make people of that leave that and then come and invest in your firm, right? That is why you have to add risk premium to the risk free. So the premium is like an attraction to invest in that equity instrument, right? But then the risk premium now is diluted by the systematic risk, which is a risk that affects everybody in the market. Do you understand?
Yes, sir. Yes, sir.
Does it make sense?
To some extent, sir. But I'll have to read it, sir.
Okay.
Thank you.
Okay, no problem.
Thank you, sir.
Yes, Mr. Sharafa. Mr. Olawale Sharafa. Okay. So in the absence of question or questions, Mr. Jimo. Isiak Jimo. Okay. In the absence of questions,
Sir, this is your
permit me to call it a night here. Thank you very much for joining tonight's class. See you again next week. Bye.
Good night, sir.
Good night.